Hello, everyone. Today on the Final Bar, recovery day for the S&P 500, the NASDAQ, as energy stocks push higher. Another heavy earnings day with Apple, Amazon, Coinbase, all after the bell. And finally, Jeff Hughes of JWH Investments coming by, talking about falling stocks and higher rates. Just how high can the 10-year yield go? Ladies and gentlemen, this is the Final Bar. Hey everyone, Dave Keller here with StockCharts.com in a sunny Redmond, Washington. Welcome to the Final Bar. Great to have you join us every weekday after the close as we break down the action in the markets using the best practices of technical analysis. The technical toolkit, I would argue, is the best way to really understand what's happening by focusing on the market action. Price action can tell you a great deal about what's happening, about how investors not just are thinking or what they're feeling, but how they're voting with their capital. And when we're looking at stocks and bonds and ETFs and cryptocurrencies and commodities, we get a sense of the supply versus demand, the fear versus greed, the euphoria versus desperation, how all of those emotional drivers of investment decisions tend to net out in price movements. And one of the most important parts of the technical toolkit, I would argue, is looking for extremes, looking for potential inflection points by recognizing when markets reach an extreme level. And I think that's one of those periods we're sort of navigating right now. We've had an incredibly strong 2023, but in the last couple of weeks, all of the bright, glistening, shiny, outperforming stocks starting to look a little less shiny, a little the luster coming off of there, with names like Apple and Microsoft starting to pull back. Maybe Apple not as much as others, but Microsoft, Netflix, others testing their 50-day moving average, Alphabet and others. Do they hold that level of support or do they break? We're starting to see more and more breadth indicators starting to roll over. Yesterday, we talked about the bullish percent index. Today, we'll share that the McClellan oscillator has once again turned negative. We've got a lot of charts to go through as we make sense of these markets. So let's get right to our market recap. Before we start looking at the S&P, the NASDAQ, the Dow, and all the charts, let's answer a poll question we asked you recently on our social media accounts. So make sure you follow us on the Twitter, elsewhere, and certainly on YouTube. Subscribe to our channel there. You'll get the next vote. Or you get the next poll. We asked you which asset class performs best over the next 3 months. Stocks, non-U.S. stocks. So U.S. stocks, non-U.S. stocks, bonds, or gold. 41% of you said U.S. stocks in the form of the S&P 500. Gold was second with 30% of the vote. Bonds with 22%. EFO, which is Global Developed Europe and Asia, 7%. So two things that I always take away from these polls. Number one, what got the most votes? And the S&P certainly got the most. I would say if the choice was between stocks and bonds, I would say stocks 10 days out of 10, and again on day 11, of course, because the ratio of stocks versus bonds over time has so clearly followed equities. In up phases and down phases, bonds just have not been a particularly great relative bet, and with a rising rate environment, highly unlikely that's going to be a good opportunity, as we'll get to with my guest today, Jeff Hughes, and I would completely agree with that general assessment. Gold is one of those that gives me pause, though, because if markets get defensive here, if growth stocks sell off and the S&P starts to come down, the NASDAQ pushes lower as growth stocks have a tough earnings season. We'll see if we get more data points along those lines today. Then all of a sudden gold could be an interesting safe haven. It's not been a particularly great safe haven, but we'll see what happens. But I'm always looking at what happens, what gets the least amounts of votes, and EFA comes in at number 4. Not a horrible chart, to be honest with you. The global EFA, Global Developed Markets, is sort of developed Europe, developed Asia, sort of making this consistent pattern of higher highs and higher lows, just like the S&P, of course. The challenge is when that trend stops, right? Greg Morris, one of my mentors, always said, all new highs are bullish except the last one. So recognizing when the trend starts to shift, when we make new highs on weaker momentum, when the upside pressure starts to alleviate, that's where I would be concerned. The biggest problem with EFA, and the reason why I would not vote, is because of the relative strength, which is so clearly favored U.S. over non-U.S. The dollar's part of that story, but just the overweight and growth certainly has been it as well. I'd probably vote gold, to be honest with you, but 3 months takes us into the beginning of September, October, November. Even if we do get a decent pullback here, do we get a recovery before the end of October? That's certainly an open question that will be answered over time. Let's get to our market recap and look at the dashboard. Dashboard's a really good way on the Stock Charts platform, of course, to get a good overview of what's happening, summarizing all the equity and ETF action in one place. So let's start with the major equity averages. A lot of red here, but not deep red, right? We don't color code these too much and make it brighter red if it's down a lot, but I wouldn't be too concerned because these are not big down days, right? The S&P down about 0.25%. To 4,500, just above there. The NASDAQ composite essentially unchanged for the day, down about 0.1%. The Dow about the same. So the major averages having what I would call a digestion day. I always think about you have that big meal, whether it's a bullish meal or a bearish meal, you had the big move, and that's sort of the meal. Now it's sort of the digestion, right? You take a moment after Thanksgiving dinner to kind of sit back and let your body sort of process it. That's what a day like today is. We had the big move yesterday, the sell-off on the Fitch downgrade of the U.S. government debt, and here we are just sort of treading water and I think processing what we learned yesterday. Mid caps and small caps both down as well, but not too much, about 0.3, 0.4% each. The VIX actually back lower. If you remember yesterday, the VIX spiked in a big way, going up above 16, settling right down about to 16. Not much change from where we were yesterday, to be honest with you. Let's go back to other asset classes. Interest rates continuing to push higher. 10-year yield nearing 4.2%. We were talking about the likelihood of the 10-year getting above 4% not too long ago. Now we seem to be pushing higher as that level sort of recedes in the rearview mirror. 5-year and 30-year points both are right around 4.3%. The short end of the curve still pretty elevated with the Fed raising rates a number of times, of course, over the last 6 to 12 months, and so we still have that inverted yield curve. But what's happening is with the Fed, if they don't take any further action hiking rates, basically the rest of the curve can kind of continue higher. It's got plenty of room to do so. So for now, rates going higher, and the problem for our growth-oriented benchmarks is growth stocks do not tend to thrive when rates are going up, and that's the trend we're certainly seeing in the near term. Not much of a change to the dollar from yesterday, looking at the UUP. Finally, gold and silver, both down. Gold not by much, sort of flat for the day. Silver down by about 0.5%. Oil prices, copper prices going higher, natural gas as well. The energy sector, one of the few with a pretty decent up day. Everything else was sort of struggling today or sort of processing yesterday's drop. Bitcoin and Ether prices both higher today, sort of a bit of a rotation back to the upside. Bitcoin back above 29,000, around 29, just below 29,300. Ether prices just below 1850. And we've talked about those big round numbers. Bitcoin around 30,000, Ethereum around 2,000. I would feel much more confident about the upside potential if we're able to get above those key levels of resistance. What's happened in the last couple months is we've attempted to do that a number of times, but have not followed through. Every time we've tried to get above there, Bitcoin has gotten at best up to around 31,000 and then has failed to stay, sort of gets below 30,000 again. So Bitcoin above 30,000, that's a different chart we'll start to talk about a little bit more. For now, I think still languishing below a key resistance level. Let's look at a chart of the S&P, then we'll break down a breadth chart or two and look at some individual names on the list for earnings today. When we're looking at the S&P daily chart, here's yesterday's drop. And as we talked about on yesterday's show, we have this phenomenon called accelerated trend lines. And that's when you have a market that has a particular trend, or I guess another way, the trend has a particular pace, because any sort of trend, regardless of what axis you use, the market will have a certain slope based on that scaling that you use. And then the slope can change. And either if the slope slows down, we can break below trend line support, and then we have to start thinking about whether this is the beginning of a further rotation down, or the price gets further and further away from the trend line, which means the slope is actually increasing. And that's what we've seen really since March, is the price getting further and further away from trend line support. So I drew another trend line there connecting the March and May lows. We've gotten further away from that. We keep drawing these accelerated trend lines, which means it's tracking an accelerated trend or an accelerated momentum behind the market. This week now, with yesterday's drop on Wednesday, we dropped below that last trend line. So I immediately start to look to the next one. That next trend line is right at the 50-day moving average, currently around 4,400. So I always, when we have an initial drop, I always have that first line in the sand. And what I like to do with a level like 4,400 is tell myself, as long as we hold that, any pullback is at worst just a brief pullback, right? It's just an initial move. And then, when we would break 4,400, I guess if we would break 4,400, that's when I would agree to revisit sort of a fairly constructive pattern, right? Because what that means is there's plenty of room below the already, started drop to still make a higher low and still be above the low from early July, to still sort of be within this shorter term uptrend that we started back in March, really. We'd break below 4,400. All of a sudden, you have to sort of rethink the structure, I would argue, and you'd have what I would call a change of character, meaning that this uptrend is now clearly no longer an uptrend, at least the way we defined the uptrend before. So 4,400, in my opinion, a really good alert to set. Go to our alert engine and just have the platform tell you, text you, email you when the price of the S&P gets below 4,400. I think that's a really good place to start. And instead of worrying about every flickering tick between now and then, now I have a line in the sand. And once we break that, then I have to revisit a thesis. Two breadth indicators I'd love to take a moment and show you. First one is looking at the S&P, and then we have the percent of S&P members above their 200-day moving average, the percent of S&P members above their 50-day moving average. This bottom series, the percent above their 50-day, has gone from 90% about 2 weeks ago down to around 66%. Now, to be clear, these are still not bearish numbers. These are still bullish numbers, right? Over half of the S&P still above their 50-day. We talked about how the S&P may be pulling back to its 50-day, currently around 4,400. We talked about names like Alphabet bouncing off their 50-day. And yesterday, we went through some of the other, earlier this week, went through some of the other FANG stocks and others sort of testing their 50-day moving average. Actually, I just posted a video to my YouTube channel called Market Misbehavior yesterday, dealing with stocks pulling back to an ascending 50-day moving average. So you might want to check that out if what I said just now doesn't make a whole lot of sense. So most stocks still above their 50-day. The challenge, or I think the concern, needs to start when this indicator goes below 50%, because that tells you most stocks are unable to hold that level of support. The fact that we've gone from 90% down to 66% tells you that things are starting to get a little bit worse for sure. That means almost a quarter of the S&P in the last 2 weeks used to be above the 50-day and now is below. And that usually doesn't happen in a raging bull phase. That's something that happens during a pullback phase. But watching to see if these can hold 50% can often be a helpful way of differentiating a brief sort of benign pullback versus something a little more significant, a little deeper and more sinister. I mentioned the bullish percent index on yesterday's show. We dug in a little bit into the point and figure world, talked about that breadth indicator and how it had gone to more of a sell positioning, lining up with previous pullbacks over the last 18 months. Today, I'm ready to share with you another breadth indicator going into a bearish mode. This is the McClellan oscillator. And the McClellan oscillator is really a derivative of advanced decline data. Advanced decline data, of course, every day at the end of the day, how many stocks closed up, how many stocks closed down. It's a very basic measure of participation, of market breadth. And we can accumulate those values over time to create what's called a cumulative advanced decline line. And that tells you over time are more stocks closing up or closing down. Take that a step further, smooth it out with some exponential moving averages, and you have what's called the McClellan oscillator, basically turning that advanced decline data into an oscillator. If the oscillator is above 0, it tells you the advanced decline data is positive. If it goes below 0, the advanced decline data is more bearish, telling you that the internals of the market are swinging from positive to negative. That is what we saw. Now, the last time we had this specific pattern where it was above 0% and dipped below 0%, it was only for one day back here in mid-June before we went right back up, and it suggested that uptrend was still in place. So on a day like this, I always look to see if there's confirmation on day 2 or if we bounce back up, because a lot of times you'll get these little whipsaws on an indicator like this. However, if you look back at these red shaded areas, when the indicator has been below 0, it has been basically the meaningful pullbacks over the last 12 months, just in this period that we're looking back. If we dialed the indicator back to previous years, you'll see in a very similar pattern. Green is bullish, red is bearish, because it's looking at the advanced decline data underneath the action of the S&P. The fact that the McClellan oscillator at today's close has dipped below 0, another bearish sign from a key measure of breadth telling you that the internals of the market are getting less and less positive. Let's look at some individual names. We have a heavy earnings week. Again, in a 30-minute show, we just don't have enough time to get too deep into the individual names at play, but I'll highlight a couple that are all reporting after the close today. And again, as we're doing a show right after the close, it's sort of real time. We're tracking to see what's happening in the after hours session, see what sort of reaction we get. Of course, when a company reports earnings, there's often an initial reaction. You have an earnings call soon after, sometime after the close, where there can obviously be a lot of movement when the CEO and CFO and others are taking questions, talking more about a longer term outlook. So we'll probably have a lot more to unpack through the after hours session into tomorrow. Apple leading into today's report has overall, of course, been fairly constructive, right? One of the best performers in the S&P, the largest with the market cap just above 3 trillion. Although that 3 trillion mark is getting closer and closer now. It was well above 3 trillion not too long ago. It's now starting to come off just a little bit off of all-time highs, but for now, obviously, still in an uptrend of higher highs and higher lows. That 50-day moving average is currently around 187, and that's right around the low, the swing low from early July. So if we get any sort of negative reaction to earnings today, that's a level I'd be looking for. The 50-day, that previous swing low around 187. We stay above that, things aren't that bad. We get below that, I'd probably be revisiting the overall sort of bearish structure of this chart. And I can't help but notice on the chart of Amazon, the bearish momentum divergence, higher highs June into July, lower peaks of momentum, kind of a classic divergence, which usually happens at the end of the move. For now, Apple kind of trading around 193 in the after-hour session. We'll see what happens as things continue on through the course of the day and into tomorrow. Let's look at Amazon, another company reporting earnings this week. It's actually jumping higher in the after-hour session, currently around 137 or so. It's up about 6.3%. From the close. After-hour session is a little less liquid, a little noisier, so let's not draw any conclusions until we sort of process all of it. But again, with Amazon, you have the same pattern as Apple of a bearish divergence, higher highs in price, lower peaks of momentum. That usually happens at the end of the move. Now, what's different with Amazon is it's actually already pulled back. It's been testing the 50-day moving average for the last week and a half. And all else being equal, a chart like this is the chart that I kind of like to consider as a buy on the dips candidate, right? Is this an uptrend that continues, and a pullback to an ascending 50-day is a time to ride things higher? For now, Amazon actually doing that and bouncing up to around 130, 137 or so. We'll see if it's able to sustain that as we process its earnings release, and again, read through some of the comments from the management team to see what's next. But for now, Amazon, another chart sort of to be aware of. Final one we can get to, and then we'll have to take a moment of a break. Coinbase. Coinbase, of course, a good proxy for the crypto space. Obviously, that's the core business. It's sort of an interesting chart in that it hit a clear resistance level around $80 a share has been a real significant resistance level starting last fall, but continuing to be resistance in February and again in March. We broke above there in early July and then pulled back, and now we're sort of right nearing that 85 level. And that would be the potential level of support given where we broke out. After hours, trading a little bit higher, around 97, so we're sort of right in this range, still sort of in the range we've been in over the last couple trading days. But I think Coinbase could be an interesting one because you can usually unpack some long-term perspective about cryptocurrencies, what their business is, and how it's evolving. And overall, the market actually treating it pretty well after the earnings report today. That's it for our market recap, folks. I want to bring on today's guest, Jeff Huge, here in a few moments. Before we get there, just a couple quick announcements. First off, we welcome your questions. The Final Bar mailbag is fueled by people like you running into things as you're trying to use the technical analysis toolkit and sharing with us your questions. We are here to help point you in the right direction. Our email is thefinalbar@stockcharts.com. On Twitter, just tag us in a comment @FinalBarSCTV. And on our Stock Charts TV YouTube channel, just need to drop a comment below the video that you're watching. Don't be afraid to subscribe to the Stock Charts TV channel while you're there, but drop your comment below and we'll look for your questions and hope to hear from you and answer your question live on the air on Friday's show tomorrow. Also, just as a reminder, I'll be speaking at the Money Show coming up next week in Las Vegas. I'll be going down there on Monday evening. Excited to reconnect with some of my mentors, to be honest, like Larry Williams, Tom DeMark, John Bollinger, who will all be presenting. I'll be doing two sessions, one a brief 30-minute session with some of the top charts I'm looking at between now and year end, and then a 2-hour masterclass I'll be giving next Wednesday, where I'll share with you the technical analysis checklist that I use when I'm evaluating a chart for the first time. You can find all the information and sign up for both of those sessions and many, many more at stockcharts.com/moneyshow. I want to welcome on today's guest, Jeff Huge. Jeff is the Chief Investment Officer of JWH Investments, editor of some really good newsletters, including Alpha Insights for Institutions and Huge Insights, which is a really well-done retail newsletter, which I'd encourage you to check out. Coming to us from Minneapolis. Jeff, good to see you. How are you?
Yeah, terrific, Dave. Great to be on the show.
It's always good to connect with you, Jeff. And I love your toolkit. You use a number of things like Elliott Wave, which are not things that I use often, and I've always found it so helpful to see what you're seeing and relate it to what we're talking about on the show. I'm especially excited to talk to you this week because we're starting to see that rotation away from growth And I'm curious to get your take on whether this is the beginning of something more or not. So without stealing any of the thunder of where you're going to go, first let's talk about options, because the VIX has become a lot, it's jumped from 13 something to 16 something very, very quickly. A lot of people are focused here. What do you think is happening with the VIX and with options in general?
Well, I think options are the tail that's wagging the dog at this point. It's really been driving prices higher. As you can see, the top frame of this chart really talks about the skew index. And anyone who's familiar with the skew knows that anything over 100 is elevated. 100 is kind of the normal skew for volatility. We've been as high as 158 recently and are now right around 140 or so. And what we think is driving the skew up here is this reticence by investors and hedgers to really sit back and watch their put premium decay. And quarter after quarter having to roll puts, it gets costly. And so after talking to a number of institutional hedgers, I've found that institutions are shifting more to a put spread strategy, whereby they'll buy kind of a nearby put, maybe the S&P 4400, and they'll sell something that's deep out of the money, like say the S&P 3800. So they're buying downside protection, but they're selling extreme downside protection. And that has caused the skew to move out of its normal sort of realm. And that only stays that way until the market rolls over. It wouldn't take more than, say, a 10% correction in stocks to bring that skew index right back from whence it came, so to speak.
Interesting. So the scenario I think you're illustrating, which makes a lot of sense, skew could come down. That would line up most likely with VIX spiking higher. And I can assume as we follow that progression, stocks going lower in that scenario, right?
Yeah, there's a bit of a gamma squeeze that's been underway that's really artificially suppressed the VIX. It's pushed it down below its 2021 lows for about the last 2 months. And what happens if you're an options market maker and you're offering a call option on Apple and you get lifted, you got to go buy some Apple stock to hedge that position, right? And so, the advent of zero DTE, 0 days to expiration option trading, where you got retail gamblers and institutional gamblers too, basically coming in and betting on a price swing daily, right? And since the stock market's up 70% of the days, the odds are in your favor. People are buying these, and as they lift the price higher and higher, these market makers on Wall Street who own the other side of your trade, they are forced to chase and buy the stock. And it's basically this positive gamma has squeezed the stock higher. But the slightest little reversal in that turns it from positive to negative. And that forces these market makers to sell their hedge book. And so this forced selling can have the exact opposite impact. And that might, in fact, result in a volatility surge, which could carry the VIX up back toward its highs in the mid 30% range.
That's so helpful, Jeff. And those zero DTD options sort of came out of nowhere. All of a sudden, they're an incredibly liquid part of the options market, heavily used, as you mentioned, by retail and institutional investors. And I think the ripple effects of that new part of the options space certainly continuing to be felt. Can we talk about the S&P? Because you've often shared your wave count of the S&P. I'm curious, with how things have progressed higher and now starting to rotate lower, where do you see the S&P now in terms of an Elliott structure?
Yeah, well, just to preface this by saying, for the last 2 to 3 months, I've been dead wrong, and we've changed our wave count because I was reticent to embrace the idea that the initial decline into the October lows was a leading diagonal. And once I really read through it, and in fact, in my newsletter, we actually put in an insert, a textbook insert taken from the textbook Elliott Wave Principle, where this exact diagram was drawn out in 1978. It looks identical. And Dave, what I could tell you is it's a complicated pattern. And in addition to this leading diagonal, which is of the expanding variety, very rare, we also have a truncated fifth wave into the October low. And then in the advance out of that, we got kind of muddled up in the banking crisis. And in retrospect, we can look back and we can see a flat wave correction for wave B. And so that leaves us with the final wave C rally in this counter trend advance, this corrective waveform of A, B, C at intermediate degree, which ultimately traces out primary wave 2. And we've retraced 84%, which is between 78.6 and 89%, which is typically what you would expect to see a retracement for a leading diagonal. So it couldn't be more textbook than this. And in fact, what we've seen is a recent blow off top with a gap to the upside, and now a rollover with a gap to the downside. And what I think where we're at here, we had an extended fifth wave and a fifth of a fifth that actually subdivided even further. And that ended on July 27th. And I think primary wave 2, the counter trend advance to the upside, has terminated. And we are now in the very early stages of primary wave 3 down, which should carry the S&P down to new bear market lows.
You have indicated on your chart some of these price gaps, I think, from the advance off of the March low. Can you talk a little bit about those gaps and why those could be important as we try to navigate through August, September, and beyond?
Absolutely. Price gaps basically are kind of a magnet for price. They tend to be filled eventually, right? And they don't have to. It's not required. But oftentimes we'll see a gap filled initially. And once we break through the lower end of that gap support, it opens up the door to the next gap and the next gap. And there's three very obvious windows in the chart pattern that were never filled. And so we've highlighted those, and we think it's possible once we break below that ascending trend channel, that Elliott channel with that final wave C, that should really open the gate to take those gaps and fill them, and should eventually carry the market much lower.
It's so interesting the way that this count is playing out. The initial move lower, of course, during the seasonal part of the year, when August, September, when markets actually tend to be pretty weak. So it's lining up pretty well seasonally with what you're showing in terms of the structure. To finish off, Jeff, let's talk about interest rates. 10-year yield now back above 4%. Where do we go from here? What sort of upside do you see for rates, and what does that mean for equities?
Well, let me kind of tie this into the S&P count by just saying that the biggest pushback I get from my institutional investors on the count is that there isn't a catalyst. They're like, what's the catalyst? We need a catalyst. Well, I think we just got one with the downgrade of the U.S. debt by Fitch. And, Fitch is a third-tier credit firm. We already saw S&P downgrade the S&P, 12 years ago. That ended up in a 10% correction. I don't know that, there's any real weight to the change in Fitch's decision. It just basically wakes people up to the fact that we've got a serious fiscal spending problem in the United States of America, and it's not going to go away. And what I think it is, it's catalyzing investors to recognize that there is a significant potential for yields to move higher. We're at 5.5 on T-bills right now, and to see this curve start to normalize, where we get 10-year bond yields north of 5.5%, would not be unusual, right? It's normal to have a positive spread to the yield curve. And so, what I foresee happening is a rather quick trip up to the 5.5% range. And this long-term chart of the 10-year bond yield shows, technically that we've got a range of resistance in that kind of 5% to 5.5, midpoint 533, that should be a magnet for bond yields eventually as they get moving here.
And I think your other chart of the 10-year yield here, looking at that was your monthly chart, your daily chart, really showing this higher low and then a break above resistance, right?
The classic inverted head and shoulders pattern with a strong right shoulder. The breakout is confirmed at this point. And I think if we take out that 433 level, the initial move is going to be to 495 with a stretch move to about 440.
Can you talk a little bit more, just to finish up, Jeff, what higher rates? I mean, it makes sense in terms of the historical trend and what we've seen recently. What does that mean for a growth-led market, which has been the story of 2023?
Well, classically, you would expect higher rates to pressure multiples for growth stocks, especially companies that are not growing earnings, they're just growing revenue. So there's a high terminal value, and higher interest rates are going to pressure that terminal value, and they're just going to pressure valuations in general. It is not going to be good for growth stocks. And my suspicion is there is a rotation under the surface right now out of growth into more traditional value and industrial sectors like traditional industrials, materials, energy. All of these areas are pretty well funded. by the infrastructure legislation that's come out over the past year and a half or so. And looks like there's something north of $1.5 trillion in infrastructure spending that will go into the market over a 10-year period of time. That's a pretty well-funded trade for industrials, in my opinion.
That's a really good point there. Potential rotation, maybe from the new economy names back to some of the old economy names. Jeff, we'll have to leave it there. Thank you so much for coming. You really, as always, shared some really thoughtful charts. You dug into my CMT backlog of Elliott Wave patterns, so thanks for that nudging as you were going through the framework. But again, thanks for coming on the show, and be well and stay safe there in Minneapolis.
Always a pleasure, Dave. Thanks.
That's Jeff Hughes. Jeff's the Chief Investment Officer at JWH Investment Partners, coming to us from the Minneapolis area. He writes a newsletter called Alpha Insights for Institutions, and his retail newsletter, Huge Insights, really well done. You can find more information at hugeinsights.substack.com. I'd encourage you to check that out. We have to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We're talking in our market recap about breadth conditions. Yesterday, it was about the bullish percent index, using point figure charts to think about a framework and recognizing how so many stocks were in a bullish point and figure regime and now starting to rotate back to a less bullish point and figure regime. Today, we talk about the McClellan oscillator, which is a breadth indicator derived from advanced decline data, uses moving averages to smooth out that data, and overall just turn the advanced decline data into sort of an RSI for the markets, right? Are we overall in a bullish or bearish configuration? We were bullish up until today, and as of today's close, we've rotated back lower. Now, I've highlighted on my chart these just big red and green shaded areas just to show the fact that when the indicator is above 0, suggesting the advanced decline data is constructive. You can see that coincides pretty consistently with the nice uptrend phases in the market over the last 12 months. When we go below 0, we go below that into that red shaded area, tends to be those more significant pullbacks. In February, in August, September of last year, those are some of the periods, and even December of last year, sort of a 3 to 5% pullback. So all of these things one by one sort of lining up, suggesting that the strength that has taken us through the end of July is starting to dissipate here at the beginning of August. Chart number 2, all about earnings this week, and we're sort of in the meat of earnings season. Every day, I feel like there are significant stocks reporting earnings. Today, after the close, Apple and Amazon, Amazon having a nice bounce higher in the aftermarket for now. We'll see what happens as investors digest what the company has reported, and always very crucially what the company and the management team is reporting on the earnings call. We'll see what happens for now. But what I'm thinking about as I'm looking at these charts, number one, clearly in an uptrend still, right? Both of them up until today have been making higher highs and higher lows. Both of them currently showing a bearish momentum divergence, and that's when the price is going higher. And the RSI, not shown on this chart, actually sloping lower. And in both cases, you have that bearish divergence. Finally, the 50-day moving average in play. As I mentioned on my YouTube channel called Market Misbehavior, just yesterday, I posted a video about some of these key stocks testing the 50-day, how important of a measure that could be to determine whether a short-term pullback is something getting into a more painful drawdown and something where you want to get a little more defensive. But those are two key stocks, two leadership names reporting earnings with divergences and potential support this week. Finally, bonds. I thought Jeff Hughes did a fantastic job talking about the rotation in rates. Certainly, we've seen that and felt that. You've seen the rotation higher. Here, I'm actually flipping that chart upside down by showing bond prices. This is the TLT, which is sort of a treasury bond ETF, looking at the long end of the curve. So it's basically looking at bonds 20 plus years to maturity. So it's sort of looking at the 30-year yield, but in price terms instead of yield terms. So as the price is going down, that's what coincides with rates going higher. So Jeff's charts showing that inverted head and shoulders, the break of rates and upside potential to 5% plus, coincides with bond prices going down. And this is a chart we've had saved in our Mindful Investor Live chart list for a while to show this sideways environment, right? We've sort of had this consistent range for bond prices. This week, that range has been blown out to the downside. TLT making a new low for the year again today. The momentum has gone way down and is now oversold. And overall, I think that's telling me bond prices continuing to be weaker, bond yields, interest rates going higher. Folks, that's a wrap for the show today. Thank you so much for joining us every weekday after the close for the Final Bar. A special thank you to Jeff Hughes of JWH Investments joining us from Minneapolis. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.